Hey everyone, this is Climb by VSC, a weekly show covering the most exciting developments in the world of climate innovation. My name is Vijay Kapoor, general partner of VSC Ventures and co-host of Climb. Every week, I or a member of our VSC team will speak to a pioneer in the climate tech world about emerging technologies and novel ideas that will turn the tide on climate change. We've heard enough of the doom and gloom. It's time for stories about purpose-driven innovation that lead to sustainable, positive change. I'm so happy you've decided to join us. Now let's climb.
Hi, everybody. Welcome to Climb by VSC. This is a podcast where we interview guests on their perspectives and best practices for company building in climate tech. And I'm thrilled to have one of our co-investors and friends, Harsh Patel from Wireframe Ventures. The fund is a seed stage fund helping founders improve the health of the people and the planet. And Harsh himself has 20 years of experience in building, operating, and investing in companies. And some of the companies, very well-known companies such as Palantir, Goat, Mammoth Biosciences, and Cinnamon, the last two of which we've also been grateful to get to work on together. So really what we want to do is dig into your background, Harsh, and give founders lessons on the nuances of building in this space. And with that, welcome you to the show. Thanks for coming on.
Great to be here.
Let's just dig in, man. Tell us about Wireframe and sort of, your entrepreneurial journey to get here.
Yeah, no, awesome. Thanks again for having us. I started out actually as an engineer, then became a founder. I was a founder twice, actually, went back and forth between being a founder and a VC, and then ultimately combined those two things. The only way you can be a founder and a VC at the same time is to start your own venture fund. And that was a very long journey, and we can dive into whatever parts of that are interesting. But I'd say the reason we founded Wireframe, a couple of reasons. One, first and foremost, we saw venture really bifurcating. When I was a young founder the first time, a very long time ago, venture was $200 or $300 million venture funds. There were no micro VCs, and there were no billion-dollar funds, right? We were kind of in the middle, very venture classic. And then over the years, you started to see these mega funds established, like cross-stage, cross-geo, multi-billion-dollar funds, and then you started to see the proliferation of micro VCs, which is great. My partner and I, Paul Schraub, were at a predecessor fund, which was kind of in a Series A and B stage. And we decided that in order for us to be the best at what we can do and also make the biggest difference, we should either get bigger or get smaller. And the right answer for us was to get smaller and to really help founders on that 0 to 1 journey. But even in a world where there were hundreds of micro VCs forming, the vast majority tended to be in traditional venture tech industries, right? So enterprise SaaS, direct to consumer, e-commerce, et cetera. And there's nothing wrong with that. Those are fantastic places to build businesses and make great returns. But we didn't see a lot of dedicated capital that had an institutional mindset that were willing to write first checks prior to product market fit in harder categories that also personally mattered to us, right? Which is a long way of arriving at this intersection of health of people and planet as our prime directive as humans, as what we want to get up every day and do and we tell our kids about. And also quite, selfishly from a financial perspective, decarbonizing the global economy is the most investable theme we will ever see in our lifetimes as investors, right? It's an extraordinary opportunity to make money. And we think about the same thing on the health side of the equation as well. So that was kind of the genesis of Wireframe. We wanted to be seed and pre-seed because we wanted to work with founders very early in their journey. And part of that was because we saw so many mistakes that typically happened by the time they got to Series A. And we thought that having been in that chair for so long, we could bring that value proposition to founders closer to day one.
Excellent. And let's come back to those mistakes as we go. But so you're pre-seed and seed. What's like typical check size these days?
Up to a $2 million check these days to lead a seed round. We prefer to lead when we can. We can obviously write a smaller check when it's pre-seed. It can be down to a few $100K. We prefer to lead or co-lead whenever we can because we want to be active participants. But in certain situations, we'll certainly be part of a great syndicate as well.
Okay, got it. And then how about sort of one thing we're seeing is like a bifurcation of types of climate deals. There's hardware deals and then there's software deals. Where do you sit in that?
We are technology agnostic. My personal background is software. I was a software engineer myself. I kind of a big data background. But we've done tons of hard tech, deep tech, hardware, and pure software and SaaS, right? So I'd say we're much more excited about the what and the why and the who than the how of your startup, right? There's a lot of ways to get to where you're trying to go. We're anchored primarily on who the people are that we're going to go on that journey with, where they want to go and why they want to go there. And then there's a lot of different ways to do that. And the last thing I'll say is that I think one of the things that I'm most stoked about in climate and on the health side is kind of the intersection or the remixing of traditional software, machine learning, data, IT type technologies with chemistry, biology, material science, et cetera, right? So mixing those together in interesting ways, I think, is a huge source of opportunity for startups in climate.
Got it. So one thing I've learned as sort of a newbie in investing in this, specifically in climate tech, is that there's so many different sciences out there that matter to where we want to get to for this planet. So how do you diligence these? So like when you look at these founders, like how do you diligence things like this is a very specific material science company in this space? But like I could only imagine as a smaller firm, you've got areas that you understand, but certainly it feels like there's so many new areas as well. How do you think about like basically deciding on backing some of these areas? Do you have like advisor networks? Are you betting on the founder? Like how do you think about that?
Yeah, no, I mean, it's a great question. And, I'll point out that we think about climate tech as a theme, not an industry or a sector, right? Because it's not a monolith, and kind of embedded in your question is we're talking about, again, decarbonizing the global economy. We're talking about changes in consumer behavior, changes in financial market behavior. We're talking about B2B kind of behavior shifts, right? This is across, every spectrum that you can imagine. And it's across technology, right? It's everything from biology to pure software to consumer products, right? And so I don't think anybody could, with a straight face, say that they're experts on every single sort of subsector of the economy or every single subsector of technology, although VCs often like to portray ourselves as such. I think the reality is that there are pockets within that where there's an intersection between one, where we think there's enormous opportunity, where we think we are particularly adept, we have great experience, we've done things in the past, we have good networks, and those tend to be the areas where we might focus in most of our time. And then what I would say is because this is a fast-moving environment, we are constantly trying to stay in front of categories that might be newer to us. And there are different ways to do that, right? So it might be exploratory checks where we write a smaller check in an area that we know we're not expert in, but we're going to work alongside founders that we get really excited about and co-investors that we get really excited about because we think there are multiple opportunities there over time. That might be how to explore something that is new. But in core areas, electrification of transportation, electrification of the home, certain aspects of the intersection of bio and climate, those are all areas that we've done for a long time. We have native understanding of those categories. We have fairly deep, long-standing networks that we can look to of both founders and people in industry that we can look to help us diligence those things.
Got it. And what are you seeing in terms of the founder profile coming in right now? Meaning first-time founder versus second-time founder in something in sustainability versus second-time founder coming from traditional tech?
So I'd say the most exciting thing happening in climate for me right now is the intense interest and flow of talent, right? Not necessarily people who've already made the move, although there's a ton of people who've already made the move, but also folks who really would like to. And talent is the lifeblood of startups, right? I mean, this entire thing starts and ends with people. And for us, I think the number of people that want to create new companies as well as join exciting companies in climate is the single biggest kind of leading indicator for us that there's huge opportunity to come, right? And I think the phenotypes, right, the profiles of founders vary, right? You've got everything from a tech founder or product manager at a big tech firm that wants to spin out and start a company and has had this idea for a while and really wants to do something that they're more personally motivated by and wants to make a move into climate. You might have somebody on the other end that's a scientist, a PhD out of a lab that's never really even been in a commercial sector. But for decades, those people were told you've got to be a professor, or you've got to go join a lab somewhere at a large company. And now those young PhDs believe, why not me? Why can't I start a company and be a founder myself? Right? Why do I need to let somebody come in from the industry and take over the business and I'll just kind of stay in the lab? Not anymore, right? So I think those are very, very different profiles, but they're all welcome and at home within kind of the climate tech Big Ten.
So you're saying this influx is coming in of people, talent. When did that happen? Could you actually think about a timeline?
I think it's been happening. I think it's been happening for years, but I think it's really starting to inflect almost within the last year or two. And I think part of it is driven by COVID and the pandemic. I think part of it is driven by the fact that climate change is now, it's impossible to ignore, right? For any thinking person, for anyone that is paying attention to what's going to happen 10, 20, 30 years down the road. I think it's no longer a back room kind of conversation, right? It's front and center. It's a kitchen table conversation. And then when you factor into that, during COVID for 2 years, everybody was questioning everything, right? Where do they live? We should move. What's our lifestyle? Like, do I want to work from home? Like, what do I, my kids, unfortunately people had suffered with COVID or lost loved ones. I mean, it was a really interesting time for introspection for almost everyone on planet Earth for 2 years. And I think one of the things that came out of that, many things came out of that, but one of the things that came out of that is like, what the hell am I doing when I get up every day? And is this really the best thing I could be doing for myself? Is this something that I'm really proud of telling my kids about when they're older, right? If life is short and people are more in tune with mortality as a result of a global pandemic, I think people had a kind of a realization, right, that time is precious. Don't waste it. So if you're a badass engineer, do you really want to be doing ad optimization, for the rest of your life? Maybe you did do that. Maybe you made some money doing that. But if that's not where your heart and soul is, why don't you apply your innate skill set to something that is equally lucrative, right? Again, like, to be really clear, like, you can be extraordinarily successful, but you also get up every day and be more excited about what you're doing. And I think you combine all those things together with the fact that you are now seeing, we just did this, we're a sponsor of something called Climate Draft run by Jonathan Strauss, which is a great initiative to kind of help bring people from classic tech into climate. And they just posted a great set of resources yesterday due to the tech layoffs, right? And we've got these huge tech companies making massive layoffs, which is awful for these people. But again, I think there's another opportunity there for maybe now's the time. Right?
Yeah. It feels almost poetic that Web 2 and crypto are shifting the labor at the same time climate has the capital to back these people. I mean, doesn't it feel like almost rhythmic what's happening time-wise?
Look, and I think again, not to steal an Elon phrase, right? But power to the people, right? I mean, people, at the end of the day, we are going to have to take this bull by the horns and fix so much of what is broken, right? Speaking specifically about climate, but in that opportunity, the governments are doing extraordinary things, right? The U.S. just passed the Inflation Reduction Act, which was the single most kind of compelling piece of legislation around climate ever passed here. Extraordinary amounts of money, right? $370 billion allocated. And we think that leverages into $3 trillion worth of commercial sector spend that now can kind of be based on that or triggered off of that. So you've got extraordinary governmental intervention, but that's not going to be enough. It's never going to be enough, right? This is only going to work if we all give a shit, if consumers change their behavior, if businesses change their behavior, but most importantly, if there are products and services that are just better that also happen to be more climate positive, right? And so in order to do that, you have to have the world's best product designers, the world's best engineers, the world's best business thinkers want to point their kind of talent hose at this problem, right?
Yeah.
And if you do that, you have extraordinary products, right? You have extraordinary products that people just think are better, right? As good or better than the incumbent product. And when you can do that for businesses and consumers at scale, I think you change the world.
That reminds me of a joke I saw on TikTok. Basically, if the U.S. ever wants to win the World Cup, just have all the players in the NFL and NBA play, right? Can you imagine LeBron James playing? Or, bring the best athletes into the space and you win, right?
Totally. And that, by the way, that happened in Olympic basketball like decades ago when it used to only be amateur basketball players, and then they had the dream team, right? When they finally allowed the NBA to play, and Jordan was playing on the U.S. Olympic team, and you're like some kid from like the Turkish or Indian national basketball team or something. You're like, I got to play Michael Jordan in the Olympics. Yeah, exactly. It's an unfair fight. Unfair fight, but that's exactly what we need, right? We need to stack the deck. We need to make this an unfair fight for once in our favor.
Yeah. Okay. So 2 things about, this podcast is for the founders. So what are the mistakes they're making pitching you at the pre-seed and the seed? And then we're going to get to what are the mistakes they're making once they've received seed funding to get to the A.
Yeah, great question. And so first off, I'll say, and I genuinely believe this, having been a founder twice myself, right? Every startup, every founder is a unique snowflake, right? I mean, I try really hard not to stereotype people because I didn't want that to happen to myself, but there are patterns, right? There are certainly patterns that we see. And so on the pitching side, I mean, I'd say it depends on whether or not you're talking about, like we talked about a few different phenotypes or profiles of founders, right? If you're somebody that's like a second-time founder, somebody coming out of tech and moving into climate, that's a different set of maybe questions or challenges for that founder than somebody who's a first-time founder who happens to have a deep science background, right? So I'll give you an example. It might be making certain assumptions from classic tech that may not translate, right? Might be, milestones might be different, right? Let's say that you have real experience in enterprise SaaS. There's a really well understood set of metrics that you'd be tracking, right? You'd be looking at GAC and LTV, you'd be looking at your SaaS numbers, you'd be looking at net revenue retention. I mean, there's all these things that you would use to understand and instrument that business. And you can be really, really good at that. But depending on the type of climate tech business that you're in now, the milestones might be different, right? You still have to nail your milestones in order to raise the next round of capital, but the nature of those milestones might be significantly different. The ecosystem might be different, right? I mean, some of these categories are, have slightly more complex channels, right? You might not have a product that you just put up on the internet and you have a PLG-driven, a self-serve SaaS offering, right? I mean, that from a technically speaking, from a go-to-market perspective, that is straightforward. In this case, certain parts of climate might have more complex distribution channels or go-to-market challenges that you don't, that you aren't necessarily as used to. So there are certain things that you'd run into that I think you can't take for granted as a founder coming in from that point of view. And the best way to answer that, I think, is just do your homework around, what is it about this new industry? Who could I talk to? Founders and VCs that you can trust before you go out there and pitch. And make sure that you are operating from a blank sheet of paper mindset in some ways, that you're not automatically just kind of copying and pasting. On the other side, right, for example, if you've got more deeply technical or scientific founders who are coming into this with that orientation, from their point of view, it's really anchoring around what is the business, right? What is the commercial set of proof points that I need as opposed to the scientific set of proof points? In certain areas, right, like nuclear fusion, it's entirely a scientific milestone problem right now, right? You don't really talk a lot about commercial proof points in the short term. It's just we're trying to prove some extraordinary feat of science or physics. But in most of climate, even the scientific kind of parts of climate tech, there are still very real commercial elements of the business that you should understand very early, even at the pre-seed stage. It doesn't mean that you have the answers, and it doesn't mean that you have the evidence yet. But it does mean that you've done the homework and you understand that if I'm going to be in this business, like if I'm going to do a fermentation-based, synthetic biology company, you should understand what the commercial attributes are that matter to you, right? Whether that is on the cost structure side of it, right? Getting to unit economics, understanding what your benchmarks might be if you're competing against an incumbent product in the market today. You should understand all that. And I'd say a very common problem is that folks have not done the commercial work necessary to be comparable to the scientific work, right? So it feels very much like an incredibly compelling scientific talk and not a pitch for a business. And when you're pitching investors, always look at the end of the day, it's about, fear and greed, right?
So what does that look like? That looks like the founder going and say, okay, let me go talk to the actual eventual customer of this thing now. Before
how would they do that?
Harsh.
Yeah, I think. Look, I think it depends on your stage of life, right? So just to be clear, we're not expecting that you've got a totally dialed-in business plan with exact numbers for everything or proven revenues. I mean, at the pre-seed or seed stage for these types of companies, we're not expecting it's proven. But there's a surprisingly kind of high amount of homework that you could do without a significant amount of time and effort, right? So what would that be? It's understanding what are the end markets, how do I get a product like this into the end market? What are, who are the obvious kind of incumbents, right? Are there existing technologies that you're competing against? What is their cost structure? If they're being sold by a public company, you can just go online, right? Pull their filings and look at their numbers. Like, what are the margins for that business, right? Understanding what commercial milestones you have to hit. Like, is there a cost per kilogram, cost per liter that you have to hit to be viable? And then you can connect that dot to your projections of how your science or technology is going to evolve. So now you can connect the dots and say, look, we're already here. Within 2 months, our science is going to be here. Within a year, our science is going to be there. And by the time we get to the Series A, we're pretty confident, we can tell you why, we're pretty confident we're going to get to the price point that we need to have very attractive unit economics. And here's how we're going to do that, right? So I think it's a set of basic homework around the business and around the market. And if you haven't done it before, which most of these people have not, there is so much information online, and there are so many people who will take your calls. There are so many peers that you can talk to. If you just reach out with a really well-crafted, even cold email, we respond to all those. So I think there's a lot that you can do, which I'm always surprised that sometimes people don't do at all. It's a low bar.
Makes sense. So now that's really helpful. Talk about, now that they've raised money from you at the seed, getting to the A, what are the biggest mistakes you're seeing that can be corrected?
I think the single biggest mistake is to think that the A is the same as the seed, right? Like whatever got you here to the seed round, it's a different sport now, right? And I think most founders just don't get that, because they're, if especially if you're a first-time founder, right? Now you have one data point of experience, which was the experience of raising your seed round. But the experience of raising your seed round was primarily driven by the force of your personality, your narrative, your credentials as a founder or a team, your clarity of vision and purpose, your game plan, your hypothetical projections often, right? That was what raised your seed round. That is not going to raise your Series A, right? So the rules immediately change. As soon as you raise that seed round, the rules for the Series A change, right? The Series A investors are going to be looking for all of that, plus, right, real signal, real market signal, right? We're going to want to see real customers, real validation, real sense of the fact that there's something that could scale here. And so first off, the rules change. Second off, I think it's maybe waiting too long to think about raising that round. And let me explain that a little bit more, right? And this is partly because of our orientation, having been Series A and B investors. We very literally think about the next round and underwrite to the milestones of the next round at the time we write that seed check. And we push founders pretty hard on questions about what does the next round look like, even as part of our diligence on the seed round. And the reason is because the worst thing you can do is to do the classic, I'm just going to keep doing this until I'm almost 3 months from running out of cash, and then I'm going to think about my Series A as if it's going to fit into a schedule. It doesn't. You raise your Series A when you deserve it, in the best of cases, right? Not when you need it. Because the next investor, they don't care. It's not their problem, right? They don't care if you need it. They don't care if you're running out of money. You raise the Series A because you deserve it. And you deserve it because you've proven some things to retire certain levels of risk between the seed round and the A round. And so that, I think, any founder, that has experience gets that. First-time founders may not necessarily get that natively, but we push them pretty hard as early on when we're working with them to make sure that they orient around that next round. Yeah, very early.
That's great. So as you're thinking about the A, let's say you're looking at a deal at the seed. Are you talking to the A friends and saying, "Hey, what are the metrics for this kind of a business when we bring it to you?" Do you inherently kind of have a guess on it, like? Just
in some cases, yes. In other cases, we just sort of know, right? Because again, we used to be those guys, and in some sectors, it's sort of well understood. In other sectors, it might be new, right? So if it's a deeper tech type of company, for sure, those things can be all over the map, right? There's more variance there because if it's a deeper tech business, you might not have traditional commercial proof points yet at the Series A, certainly. Where if it's a software business or a marketplace, right, or something more traditional as a business model, then we also sort of understand the traditional metrics are likely to apply. And just because you're in climate tech, if you're a B2B SaaS company, okay, well, we'll just default to looking at B2B SaaS metrics and milestones, right? That's not always fair, depending on the nature of the business, but it's a good starting point.
And so I see the Series A metrics all over the place for different types of companies in this theme, right? And you're right, it comes down to the industry, but some things I'm seeing water treatment, oh, we just need one customer. And other things I'm like, we need 10. Like, where does that, it seems all over the place to me. It seems a bit arbitrary. Is it revenue based? Is it, how is that derived?
Honestly, I think it is all over the place. And I'd say the same thing about investors as I said about founders and companies, right? Each one is a bit of a unique snowflake, right? I mean, people don't automatically subscribe to the exact same playbook, right? There's 1,000 investors out there and everybody has their own unique take on it, which is great, by the way. Like, that's an extraordinary climate for companies, right? I mean, in the old days, you had such a narrow group of VCs who I think had a narrower band of how they would assess any company, that was just a tougher environment for founders. You had to fit a certain profile pretty cleanly, broadly speaking. And now that you have such a diversity of investor types and just the sheer quantity of investors, and also that it's more geographically distributed, I think you have a lot more diversity in how investors would assess a company in a given stage at a given sector, right? Some of that might be more or less experience in certain parts of climate tech, which could be good or bad assessment. But either way, generally speaking, more choice, more optionality is good for founders. I think the other thing that's happening is it depends on the sector, right? Which you talked about. Like, some sectors, there are some industries where there's a relatively small customer universe, and each of those customers is a very, very important signal and a very significant revenue driver, right? In an industry like that, you'd have a very different set of proof points than if you have a more traditional industry where there's like tens of thousands of addressable customers, right? And really, I just need to see you start selling into those. If it was the former category, maybe I just need to see you run successful pilots with 2 of those, because the industry tends to fast follow, right? Let's just say hypothetically, there's an industry where everybody kind of wants to do the same thing. If you can prove that you're best in class for something that's important to that industry, and you get 1 or 2 kind of flagship accounts, you can kind of knock over the rest of the dominoes, right? So a thoughtful understanding of that market might result in a different set of metrics that I would look for in a company, and maybe a smaller competitive set, right? Like, maybe there are just fewer people on planet Earth who can compete with you, right? Like, because of the nature of the science of the tech.
And it's very interesting. It reminds me of some of our companies where they're very small industries, meaning there's only so many companies in it. Right? There's only so many global players. And initially you're like, man, we got to stand out from the noise, cut through the clutter. And then at some point you're like, wait, we just can't piss off these 5 people. Right. Yeah. It's like the whole communication strategy changes.
Totally. And it's good and bad, right? Like, it's good and bad. Like the good thing about having a very broad customer universe is that you're not so concentrated. You're not so dependent upon one account. Hey, we didn't sell that account, or we lost that to a customer, to a competitor. Fine. Go off and get somebody else. There's tons of other accounts out there, right? The flip side, though, is that every one of those accounts is like a tiny chop of the tree, right? Like, you got to chop. You got to swing your axe over and over and over and over again consistently for a long time in order to really, make a big impact. Whereas on the other side, you really can't afford to screw it up with one of those customers if it's a smaller universe, particularly one of the larger ones, because you might not get a second chance with them, and it might not provide sort of the domino effect that you were looking for, knocking down other customers as well. So the urgency and the pressure around certain customers is different in that dynamic. So,
yeah, makes sense. How are you seeing Series A's in terms of benchmarking now that the market's corrected?
It is all over the map. 1, because of the reasons we talked about, that there's a wide diversity of investors, but 2, because the market correction tends to take a while to flow all the way back up through the plumbing, right? So it instantaneously hits the public markets and then immediately hits the round right before that, right? So pre-IPO companies, late stage growth capital, because they can be effectively marked to market even though they're private, right? Like if you're a late stage private company, but you have very well understood revenue numbers, you can effectively just be marked to market against your comps, and that'll happen immediately. And that already happened, right? It takes a little while to kind of move that back through Series B, Series A, and through seed. Seed has felt a little bit more insulated. I mean, although you're seeing price corrections there as well, partly because I think people look at seed as an option bet on whether or not the company gets, any signal, yes or no, right? So TBD. I think we've seen seed valuations hold up, maybe a bit more than we expected even to this point. A and B is getting a bit tricky, and certainly if you're like a deep tech company where you were counting on the fact that scientific proof points alone were going to be sufficient, and maybe you could delay another round before you got to a certain level of commercial milestones, that might have changed, right, your calculus. And that, I think, is even worse than the valuation conversation. We can talk about valuation too, but I think at the end of the day, that's just math, and people realize like in a tougher market, like I'm not, I had to deal with that too. I was a founder during the dot-com days, right? So one day my valuation was this, and, a month later my valuation was this, like tough, right? There was nothing I could do about it. And I still had to continue to operate that business on the other side of that. But valuation, I think, is painful at times, but conceptually easy. What's harder is what happens if the milestones changed, or what happens if somebody wants to see more commercial proof points now, and you weren't planning for that because it might take you 12 months or 18 months to really build into commercial milestones, and you designed your whole plan in spring of 2022, and now folks want to see commercial milestones. You're like, look, guys, we're not there yet. We're still a year off from that, right? And then that puts you in this trickier position of needing extension capital or something else to be able to get you there, or you'll raise capital and it'll just be raised at a valuation that was different than what you expected. So I think that, one, the numbers are all over the place. I think, two, they are, generally speaking, the trend line is certainly shifting lower. And I think ultimately that will determine what happens at seed, right? In other words, if A and B rounds consistently become very, very difficult to raise. I mean, I've seen this. I was a founder in 2000. I was a VC in 08, 09. And if you haven't been in either of those markets, it's hard for people to really grok just how bad could it get. It doesn't seem like it could get that bad. And all I can say is it sure can, and it has. It just hasn't for 12 years. But it absolutely could. And so, we don't worry too much about that. In other words, like, we don't operate as if the sky is falling and doom and gloom. Like, we're here to change the world. Like, the earth can't wait for this recession to cure itself, right? Like, particularly within climate, right? The earth doesn't give a shit about the fact that we're in a recession. You know what I mean? And if you're working on that theme, like, you can't wait that out. And so people have to continue to fight. And I think there's a certain universe of climate investors that understand that as well. So maybe there's a little bit more of a elasticity there, but it's not insulated from the realities of price A to price B to price C. So I think founders should expect that it's a trickier price discovery process now to figure out what is a fair price for your startup.
As you look at the venture ecosystem in climate, right? From my vantage point, it looks like there's interesting stacks, a little different than general tech, but quite a bit of money at the seed, which is common in general tech. But then as you go up the layers, it looks different in terms of who's investing at those rounds. It could be billionaires. It could be people that really understand a specific vertical. How do these founders think about navigating the Series B and beyond in a very niche technology where there's a lot of education required to the investor?
Great question. And I think, again, it depends on the category. And it depends on the stage. And I'll sort of try to connect the dots on those two things. Is that, first off, at the seed stage, it's relatively easy and relatively low risk for a wide diversity of funds, including generalist funds and multi-stage funds, to make seed bets, even if they know they're not an expert in that category, right? Because again, they're playing for optionality. They're playing for the fact that this sector could be something that's interesting, right? So, we've been doing climate for north of 15 years, right? Like my partner Paul's been an OG in that category deeply for a long time. I had invested in smart grid companies, a dozen years ago, and survived kind of that first wave and into the second wave. Everybody disappeared as soon as it looked like it wasn't lucrative, right? Which is the economically rational thing for those people to do. And now I think you've got a new universe of folks who are re-entering climate, or generalist investors that want to put a toe in the water, right? And we'll see sort of how that turns out, but it's ultimately going to be dependent on, are there enough exits and outcomes that justify that? And then the wheel continues to turn. But where we sit today, I think there's a great deal of interest at the seed stage, primarily because if you're a late stage fund, what the heck, we can make a bunch of seed bets and see how it plays out. If you're a generalist fund, again, climate might be one of things that you've added, right? You're also doing Web3 and you're doing climate, you're doing DTC, and DTC looks maybe, like it's challenged. We'll dial that down a little bit. We'll dial climate up. So generalist firms have the flexibility to be able to dial themes up and down and have people on their team maybe focus on that. But at the Series A and B, the universe narrows significantly, right? And it depends on what you're talking about. Again, if you are climate-centric enterprise SaaS, I think you have a big universe, because anybody that does enterprise SaaS would look at it and say, this is just like a vertical enterprise SaaS play. Like we did a vertical healthcare SaaS play, we'll do a vertical climate SaaS play. So I think your universe is large. If you're something that's more specific technology, that requires some more specific domain expertise or understanding how that business gets to scale, then I think your universe narrows. And then if you're a synthetic biology company, you're probably going to have to raise that Series A or B from somebody that has a fairly large checkbook, who really understands how that type of business gets to scale. I think the generalist capital is in less supply. The later you go up the stack, the more specific or unique the technology set is. So that applies to biotech. It applies to hard tech, bio-centric climate tech, or hardware-centric climate tech. I think you end up having that challenge. And quite frankly, part of that was what killed, clean tech 1.0, was just good companies, otherwise good companies, being suffocated for later stage capital because a lot of capital went away. And there were fewer of these climate-oriented late stage capital sources. And so those companies, many of which, obviously everybody knows the companies that didn't work and shouldn't have worked. But there were a number of companies that were actually really good companies. They just were starved for late stage capital. So now you've got people like Breakthrough Energy, right? You're talking about massive fund size. You've got people obviously like Chris Sacca and the funds that he's raising. You've got tons of folks that are out there. There are many billion-dollar class funds that are dedicated to climate. And that's a big difference between the first climate wave and the new climate wave. And I think a lot of this capital understands what they're doing better and are more committed to it for the long haul.
Yeah, that's great. That's a huge asset for founders building today.
Huge difference. But the one other thing, and we can move on, but I just do one other parenthetical on that question is that founders need to know and understand the universe of investors that would fund their business as they grow, even early in their journey, because those are relationships you should start to nurture and get to know, because some of those investors might want to get to know you at the seed round, even if they're not going to write a check. And like we talked about, if you're a startup that has a small universe of customers, there's more pressure on each one of those customers. Same thing holds here. If there's a small universe of potential lead investors for your later stage company, then there's more urgency of you not raising capital from any one of them or having a bad relationship with any one of them, right? So the onus is on you, I think, earlier in your journey to know who they are, try to build those relationships, get on their radar sooner, because there are so many fewer of them.
What's most exciting right now to you? Like, what's a particular either part of one of these industries that you're pumped on, or somebody you wish a founders started building something for right now? I think you weren't doing this, you would be doing that.
Yeah, it's funny because you'll hate it, so I'm not going to give you the non-answer that is actually the truthful answer. But like, we are so founder centric in how we think about this, and part of the reason we created Wireframe is that, and I'm not going to skirt your question, but there are segments that we care about that we think are interesting, and there are other segments that we are a little bit more skeptical of, right? For sure, and we could talk about them. But I honestly mean this when I say it, is that we built Wireframe to never be so opinionated as to miss the extraordinary founder that walks in the door with a slightly off theme or slightly crazy idea, because that is what venture is about. At the earliest stages, the single most important thing we could do right as a firm is to always maintain an active, open mind to something that might not fit our preordained worldview of how things should look, because we are not keepers of, like the crystal ball, right? We don't know. And I always say, like, we have a prepared mind, we have a certain point of view, we have an understanding of economics, we have understanding of channels, we know certain markets are tough for certain reasons, but we can't see around corners as well as founders can. And if a founder walks in the door and is looking around a corner in an area that's thematically aligned to us, we always try to maintain a sense of open-mindedness to say, wow, like that founder blew me away, even though the category of what they're working on we thought was stupid maybe, the day before.
Mm-hmm.
Right? So who's wrong? We're always willing to question the fact that maybe it's us. Maybe it's just something that we missed. Maybe it's something that we haven't thought about yet. Maybe that's something that we haven't projected a technology trend correctly, and that founder is, because they are knee deep in it. And so they see a certain trend line that we don't see. And because of that trend line, something changes 5 years out in the future, and it makes the economics different than what we think. And so I know that's not answering your question, but that is the honest answer to your question, is that we are so founder-led. Like, it's like PLG, it's like founder-led venture, like FLV, right? It's not PLG, product-led growth, but like founder-led venture investing. But it's absolutely 100% true. And so back to the question, the things that we like electrification of transportation, electrification of the home, broadly speaking. We made it, Synop, which we've done together, like, in that vein. We've had a great exit in a company called Electrify that was acquired by Ford, part of creating the new Ford Pro division. Electrification of the home. We've got a company that we led the seed round in called Span, led by a brilliant founder named Arch Rao, built the Powerwall for Tesla. He's building the most innocuous thing in your house. It's the gray panel on your wall that's an electrical panel, but it's going to be the hub of the modern electrical home. And we think about that at commercial scale as well. So electrification of building, of infrastructure, et cetera, is really interesting. We're spending more time looking at alternative forms of energy. We invested in a company that's doing geothermal for commercial and industrial scale, right? We've had some interesting work there at the residential level and at the utility scale level. We backed a company that's doing something kind of in the middle for commercial and industrial, which is a really interesting company called Bedrock Energy. That's an area that we like. I think the intersection of biology and climate is really interesting, right? So again, we've done a lot on the health side of the house in biotech, computational biology, therapeutics companies, diagnostics companies. But we start to see those worlds cross in really interesting ways, right? People that have those types of backgrounds. I think the founder of Upside Foods is a cardiologist by training, right? You start to see people that have backgrounds in neuroscience, in healthcare, come into synthetic biology and cell and tissue culture, like thinking about how do we apply this not to a human health problem, but maybe to a climate problem. And so the intersections of those technologies, I think, are very rich fields to look for new types of startups.
Okay, hot take. What areas are not investable for you? What is overhyped?
Nothing is not investable for us if the founder, checks the box that I just mentioned, right? Somebody walks in the door or something and we're motivated, then I'd say, yeah, everything's on the table. But stuff that we have a harder time with, number one, I'd say companies that have like biotech risk for pure commodity returns, who don't have a really good answer for that, right? So what I mean by that is there's some companies that have all the risk of a drug development company, right? I mean, it's incredibly hard science, it's incredibly difficult, time-consuming, capital-intensive, and then they're entering an industry where you're competing, unlike a drug, right, which is going to have IP protection and it's a premium product. You might be entering a total commodity industry, and there's a lot of really great companies in that category, but the ones that end up breaking out are ones that understand the unit economics really well, which we talked about a little earlier, right? They really understand what they're shooting at, and they understand how to scale their technology to a point where they can hit those numbers. I think there's a pretty broad universe of the majority of those companies that are going to struggle, quite frankly, with making the math work, right? So because you're competing against the price of a commodity. And
what's
this
an
is ClimateTech
example?
1.
Yeah.
So I'll give you the example of CleanTech 1.0, right? CleanTech 1.0, a lot of it was, hey, we're going to create biodiesel, right? Algae-based fuels. We're going to create something to compete with the price of oil. And literally the entire business case is we're going to do all this complex science and we're going to scale up these giant manufacturing plants to make something that is going to be cheaper than the price of oil. And all of that was built on the presumption that the price of oil was going to continue to go up. And guess what? Like back then, it actually ended up going down. And the entire business model was wiped out, right? So some of these companies just didn't make any economic sense on their face, no matter how good the science was, because they were competing against the price of commodity that nobody controls. VCs don't control it. The founders don't control it. You could have done everything right. You could have executed perfectly from the bench to a certain scale up to your manufacturing scale, and you still lose the game because you're contingent upon something that you don't control. So I'd say the same thing is like replace the price of oil, a barrel of oil, with the price of pork belly or chicken sausage or an industrial input, right? I mean, all of these things that make the global economy go round, many of them are horrible for the planet, right? So, I mean, I think the innovation in these areas is extraordinary, and I hope it 10Xs. But the existing supply is often the path of least resistance. It's already in the supply chain. It's already at a certain low cost. It's easy for customers to buy it, right? So you have to be better as a product. You can't just be scientifically better in a lab. You have to be better as a product in the marketplace. And I think we're going to get there. I think we're going to get there on a ton of these types of products, but I'm skeptical around the timeline for many of them, right? In other words, are we going to get there within the next 5 to 7 years? If we make a venture bet, do we think we're going to get there fast enough? I think TBD on some of those.
Got it. And I know we're kind of running up on our time, so just to kind of close things out, I know there's a lot of gloom and doom right now about where the planet is and certainly other parts of the world. But, what gives you a lot of hope right now? Is there any particular innovations or any particular parts of your role and your job and your life right now that give you optimism?
I am inspired and optimistic every day I wake up. And the reason is because I spend most of my days having conversations with founders telling me what they're working on. And obviously we can only invest in a very small set of those things. But just the sheer ingenuity, some of them are just crazy, right? Like absolutely science fiction. Some of them, we're like, I don't think that's going to work, but it's awesome that somebody is working on that. I would say the momentum around interest, the talent that we talked about before that wants to come in, I think the recognition globally that we don't have a choice. So let's get to work. You could get up every day and be upset about it. And I get that. Or you could do something about it. And we choose the latter. And I think aligning ourselves with founders and those founders aligning themselves with people that want to join their companies or start other companies, that flow is stronger than it has ever been before. And so again, the macro market is certainly in a tough spot, right? And we don't know how long it's going to last. We don't know how deep it's going to go. We're guiding founders that we talk to on a daily basis to be prepared to weather this storm. But startups are 10-year journeys, right? The greatest ones, 10 years or longer. It's going to take you a while. We can't, and you can't as a founder, build or worry about temporary market gyrations that are out of your control. You just got to plan for that as if it's another constraint. Right? It's a constraint in my system. Maybe my valuations will be adjusted. Maybe it changes how much money I raise, when I raise money. Maybe it changes my milestones. Maybe it changes certain parts of my business plan. But it doesn't change my fundamental reason for being here. It doesn't change my motivation. It doesn't change my goals, right? It just means hey, I got to work around these obstacles. And I think the best founders view it that way. And everybody's seen all the stories about how many extraordinary companies were founded immediately in the wake of 08, 09. So I won't repeat all that stuff. But it's true. It's true. It's really true. So that's, I think, what gives me hope and optimism every single day.
Fantastic. Harsh, thanks so much today. I'm really excited to share this episode with all the founders out there.
Well, that's it for this week's episode of Climb by VSC. Thank you so much for watching and listening. A few quick shout outs before you go. Our thanks to Harsh Patel from Wireframe for his time and wisdom. You can find Harsh on Twitter @Harsh1 and @WireframeVC. This episode was edited by Ray Rangel with production support from Celine DeStasio. To visit any part of today's conversation again, you can find the full transcript on vscventures.com. Our thanks to Josue Ramiro for editing and posting those every week. Lastly, if you've listened this far, please leave us a 5-star rating or review on iTunes and Spotify. It only takes a few seconds, really helps us out, and as far as I can tell, still carbon neutral. Well, that's it for now. We'll see you next week on Climb by VSC.